This is Brian Love from the Travillian Group. It's my pleasure to welcome you to the Travillian Group's conversation with Jim Costa, Chief Risk Officer and Chief Credit Officer at TCF Financial. Credit risk is one of the hotter topics in the bank space right now. This is obviously due to the coronavirus and how it's impacted businesses from all industries, and in turn, the banks who lend to them. To begin our conversation about this very relevant topic, I will turn it over to the Travillian Group's Head of Strategy, Brett Rabatin. Brett?
So I guess the first question I want to ask you, Jim, is, people were trying to figure out what looks like risk in this cycle. And so a lot of people have been thinking C&I might be the loan category for the industry. How do you feel about the loan portfolio risks, and what do you think looks like risk in this sort of cycle?
Well, you probably asked one of the toughest questions to answer, Brett. So I'll do my best. I would first just, hedge my answer by saying I don't know for sure, but nobody knows for sure. This is a financial crisis that was sparked by a health crisis, and in my lifetime, that has not materially happened. I think you got to go way back to 1918 for that really to show up. So I think for a lot of us, this is very new. There's a lot of tools available for us to begin to try and estimate. A lot of good research that's running around. And I think importantly for most banks, a lot of experience and common sense is really necessary right now. So, as we look at what the impacts might be, I think there are some of the obvious places like discretionary expenditures would be one area, and businesses that really are centered around people congregating. So think of things like movie theaters, air travel, hotels, those kinds of things. Those would be areas I would be watchful for. Those could show up, in your C&I book. You could also show up in your commercial real estate book. So we're very careful about that. Obviously, the commodity prices have dropped dramatically. So if you happen to be in the energy space, you've got some concerns as well. So those would be probably another C&I area that I'd call out that's deserving of attention, and not to sort of exhaust the list, but I do think if you're in a small business where restaurant is your thing, you're not going to find the same level of demand. You probably wouldn't prudently assemble people the same way now that you did pre-crisis. So if you had seating capacity for X, it's probably X minus going forward. So that whole business model for you suddenly changes. So I think, hospitality to include restaurants is going to be difficult.
That's helpful.
Yeah.
I'm curious how you're engaging with clients, regarding liquidity management to conserve their resources, and then I'm wondering how the dialogues have been with borrowers regarding their plans and access to capital and their contingency plans. How have those gone?
Yeah. So I told my team this is where we really find out if we build a portfolio that we thought we built. And so, when you prudently underwrite, you typically underwrite so that the borrower can withstand some stress, whether it be a vacancy stress, an interest rate stress, demand fall off, whatever it might be. That level of cushion that you had underwritten to is now being tested. And so the conversations are, first off, how can we be of help? I think you really want to try and use a stressful time as an opportunity to strengthen a relationship as opposed to be defensive. And so our interactions, Brett, have really been, how's your business going? And is there anything we can do for you as a bank? And, a lot of that has centered around things like the Paycheck Protection Program, PPP, and can we be a bank that can facilitate that for you? Some of that's evolving into Main Street lending. So we haven't quite engaged our customers on that yet, but the questions are starting to come. But what we like to see is that what we thought we had underwritten to is actually evident in their financials today. So part of that conversation does evolve into, how are your liquidity needs? Do you think you're okay for a while? And if so, how long might that be? And then you can look to see if you thought a stressful situation was something the borrower could absorb on your last loan review, and you can begin to size the risk level. So it's for sure about relationship building and seeing if the bank can be of support. But part of that conversation is learning the financial stress that the borrower's under. And so it goes both ways. And the conversations have been very productive. We've learned a lot. We've had some areas where we think borrowers have done a whole lot better than we would have expected, which is really nice to see. So, some of the conversations that happened at the onset of the pandemic were, the laundry list, kind of like I did, of all the problem areas. When you start digging into those sectors, you realize a lot of it is geographically based. And obviously, certain parts of the country have fared far better than others. So part of the credit risk, as I see it, Brett, is an intersection between, the financial condition of the borrower pre-crisis and where they were geographically positioned during the crisis, during the pandemic crisis. So if you found yourself in Manhattan and you showed up with, marginal financials before the pandemic, you might be having a hard time if you're running a small business. Probably a great example, right?
Yeah.
Yeah.
That's okay. And I'm curious, Jim. So a good rule of thumb for provisioning for banks for growth and the existing loan books has kind of been around 1%, particularly on new production. So I'm curious, even if it's a generalization for the industry, kind of how you think about portfolios overall in the new CECL environment, and then what might be the extra bump you think for COVID for the industry, kind of as we go through this.
Well, I'm intentionally not going to give you an expectation of where it's all going to land. Probably wouldn't be prudent to do so. It'd probably be irresponsible because I simply don't know. But what I can tell you, Brett, is that when Q1 ended of 2020, we saw that most banks provisioned, or what I would say had posted a CECL reserve all in, anywhere between, I saw some banks as low as 77 basis points all the way up to like 250. So the range is wide. The median was more like 130, 140 basis points, which, while that's greater than the historical norm, as you say, of 1 times coverage, probably not enough for what's in front of us. So my expectation is directionally, in the second quarter, those reserve levels will increase. But there are so many assumptions built around that, and so I'd like to be proven wrong that I think the economy is going to fare better than it maybe will. In my view, is that we're probably going to see, the unemployment situation stick around for some time. So I just had a chance to review some forecasts today from a consensus of economists. And the consensus outlook looks like peak unemployment in the mid-teens, with the recovery starting on unemployment in Q3 and Q4, and then sort of sustaining around 5-6%, maybe 7% in 2021, which is a whole lot higher than it was before the pandemic. So you take that and you put that into your reserving models and you see what happens. In Q1, there was a lot of, rhetoric around how high the unemployment would go. I don't think many banks were reserving for levels in the high teens. Some were. But the other thing is some banks were reserving for a W. Some were, reserving for an L-shaped economic cycle. So there's a lot of assumptions that were in it. I think the rule of thumb would be expect Q2 to be higher than Q1. The optimist in me is saying it's probably going to turn out a little bit better than people thought 30 days ago. So hopefully that gives you a sense.
Yeah, that's helpful. And then just thinking about the portfolios, kind of the industry standards have been for 90-day deferral programs. I'm curious what programs TCF has utilized and what loan modifications have been the best received and most successful for a positive outcome for your clients.
Well, I would say TCF, like other banks, has really been appreciative of the flexibility that the government has provided through Paycheck Protection Program, as well as the flexibility on TDR designations and deferrals. It really is important not just for banks, but for the economy in general. So we certainly have been accommodating to borrowers when they ask for a deferral if there was evident and documented stress as a result of the pandemic. It didn't just get handed out because it was asked for. There had to be substantiation behind it. We tried to look at a short-term solution because the environment was so uncertain. So predominantly we looked at 90-day deferrals. And in those last 90 days, we've learned a whole lot more about our portfolio through the conversations with the borrowers that you mentioned. And in a number of cases, folks are doing pretty well. In some cases, as we expected, hospitality, maybe not so good. So a lot of banks will embrace 180-day right out of the gate. We didn't think that that was a good way to go on a deferral. 90 days kind of gives you a chance to take stock of where the borrower is. There will be some of that going on into Q2, Q3 as the second tranche of deferrals. I would bet it'd be a little bit lighter than it was in Q1. So I'd say the deferral is an option, and then obviously the PPP would be the other thing that we've been looking at along with Main Street. Main Street seems to be much more limited in its applicability than Paycheck Protection Program was, but to the extent it can be helpful, we're certainly going to be there to support our clients.
Jim, I had a question for you, more from my realm, the talent realm. Obviously, the PPP program, we've talked to so many banks across the country, and it's just been a massive lift.
Mm-hmm.
Everyone from all levels of the organization chipping in. So on the talent side, I'm curious what your thoughts are from the credit and risk perspective, how this crisis, kind of shapes the needs within talent. And also, have you seen like a magnification of skill sets that are just absent or necessary now that weren't before, like workout, for instance?
Yeah. So your question is not just specifically about PP, but more broadly in the credit admin function. What are we seeing in terms of talent needs?
Yeah.
Yeah. Well, you certainly hit the one that I was going to go to, which was workout. Every financial crisis, every recession creates a demand for that specialization. And, our inflow into that SAG portfolio really has not been material, but we know it'll happen. Every bank's going to see that. And so we're looking at shifting some resources. I think there's going to be a real need to augment the resources internally with external hiring on the workout side. Some of the modeling work is becoming really interesting because a lot of the models were built around a financial recession, which was really about, excess leverage and asset price inflation in the Great Recession, not really what we're doing today. So that means that the models that you had built, you need to take another look at them and say, now that you're in a pandemic, sure, some of the end result's going to show up financially, but what motivated the borrower to react the way they did was really a health issue. And so all that modeling work is going to require you to take a fresh look and new validations, new model constructs, new data assembly. I'd say that's going to be a growth area as well. I would also say that when all this is behind us, probably a number of those execs that are far along in their career, which is fairly representative of a lot of credit folks, are going to say, okay, I've done this a few times now. I'd like to take a break because I don't think anybody anticipated this after the Great Recession. I've already seen that in my organization, Brian. A few folks had really planned on, sailing off into the sunset after a long and respectful career and feel like they couldn't just walk away right now. But that also means once this is all buttoned up, those folks are going to say, time for a break. So we're going to need to refresh our bench. I think it's as simple as ensuring a right credit training program is in there and the right talent development's been going on. Probably some select senior hires on credit adjudication, I would think would be necessary. Sort of just the garden variety, hitting the primary basis on the core credit functions are all going to be needed. And some of it is just turnover and some of it is just new demand for a really odd, financial situation that's at hand right now.
Yeah, I agree. I agree with you, Jim. Go ahead.
Yeah, I might also add that, it just occurred to me that the PPP, the example that you referenced, I think the banks that had the most success with that are the ones that went straight to a technology solution to administer the process.
Sure.
Not really new in credit, but it just was yet another example of how important it is to have an efficient technology solution to deliver a credit product. So I'm sure there's a lot of lessons learned about for those banks where it didn't go so well. They're going to want to invest in things like auto decisioning and, automated know your customer to facilitate that process.
Well, and I know that the chemical acquisition, the merger, I should say, technology played a part in that, in them being a good target to merge with.
Yeah.
So that it sounds like maybe you were ahead of the curve a little bit there in mobilizing and getting that process off the ground?
Well, I wouldn't want to crow too loud about this. I think that we did pretty darn well. Maybe not, everybody aspires to almost be a little bit better than what sometimes they've been able to achieve. We did really well. There's some banks that turned product on a little faster with higher throughput. If you look at the numbers of loans that were processed and the aggregate balances, we did really well. But there's room for improvement there. But we didn't waste any time going to a technology solution. Part of that was a result of our learnings from other investments that we had made on auto decisioning in certain credit channels. So you pull in the borrower's information through an upload, and then it runs through an algorithm, and out comes the answer. That isn't exactly what PPP was about, but the need to be able to automate that process, we had been through that a few times already at TCF, so it wasn't brand new territory for us.
Sure.
Yeah.
And just one other thing, you mentioned how maybe some executives have seen one too many downturns. I do agree with you on that point, that there may be expedited retirements over the next 2, 3, 4, 5 years. That was the only question I had, and I'll turn it back to Brett.
Okay.
Yeah. I'm curious, Jim, just, obviously the economy's slowed down, so lending's obviously slowed down with it. Outside of the PPP, have you seen the downturn create opportunities because of either specific needs or pullback by competitors in any of the loan categories?
Early indications, Brett, that those that were going to spend some discretionary dollars to travel far away, have decided to stay close to home, but not stuck inside their home. So things like marine and RV expenditures, we're getting early signs that people are running at that as their outlet for the summer.
Right.
Wouldn't have expected that. I thought it would just be a hunker down mentality, but folks still want to get out and enjoy nature, enjoy the good weather of summer. And, some of those things like, watercraft RVs are now becoming even more in demand than they were in prior years. So that was unexpected. I think there's opportunities to embrace serving the community in ways. We've had some opportunities to provide support through things like hospital beds. If you could remember, not so many weeks ago, there was a shortage of hospital facilities to manage the surge. So that created some opportunity to serving customers to finance things like equipment on hospital beds. A little unrelated to COVID, but as the date of this recording, this whole civil unrest situation is going on. And so while COVID is running through the financial system, we now have the whole civil unrest issue that is happening at the same time. It's another example of the communities need banks to be there. They need to be there on the retail and the deposit side. They need to be there to help restart those micro economies, those localities. And so there'll be small business lending opportunities coming from the unrest that we're dealing with today. So even in the greatest times of stress, there are certain pockets that are going to be growth engines.
Okay.
Yeah.
Maybe one last question. I'm really curious to hear, how the bank regulators are reacting through all this and kind of what the conversations are with them and, what they're focused on. They're obviously really intent on the safety and soundness of the financial system and banks. What have those conversations been like for you, and what are they telling people that they're focused on through all this?
Well, we've looked at the relationship with our regulators as, they're in the unique position to see what's happening in many banks. And while we certainly have a lot of great connections among peers, theirs is more programmatic and structured as a supervisory body. So we've called on them to ask for what are practices you're seeing in other banks, as much as we've shared with them what we're doing. And so it's been a really productive two-way dialogue with our primary regulators. And, for a while, we met with them every day just to share. We didn't want, our philosophy was no surprise. We want them to understand exactly what's going on. And frankly, I was impressed with their interest in digging in deep and hard from the get-go. because they, as regulators, didn't want to be surprised, which to me is an indication that they want to help manage safety and soundness in this crisis much better than, let's say, things evolved in the last crisis. So they really wanted to be on their game, and I think they have. So they've been very accommodating. The flexibility on loan accounting with delinquency designations and TDR designations has been reasonable, and it helped us serve our customers as opposed to worrying about what a report might look like with a TDR level or a delinquency level. And they've been quite flexible as it relates to administration of the PPP and just how deep you have to go in the due diligence around that process. I mean, it could really slow the process down if you had to do a deep dive on every applicant. And so there was a much lighter touch intentionally. So the regulators were accommodating there. And, we could go on to all the liquidity facilities that have been provided, the creation of Main Street lending. It remains to be seen, just how much penetration they'll get with that program. But I'd say it's been a really good experience, Brett. I've been appreciative of their level of interest as well as their flexibility. They've also been very clear that not only are they doing their supervision from an off-site standpoint because of the whole pandemic and there's not a lot of on-site examination activity, they've also dialed back the frequency of some exams in the industry. And I think that was a really thoughtful and well-timed move on their part, is maybe not everything that was going to be examined needs to happen during the pandemic. And so we've been really appreciative of that. So good experience so far. No criticisms on my part. I think it's been a really nice two-way relationship between the supervisory bodies and the banks.
Well, that's great to hear, and some really helpful information from you today. So we really appreciate it.
Sure.
Yeah,
Well,
Jim, thank you so much for your time.
Certainly.
And Brett, thanks for joining us as well. And I guess that'll end our conversation today. So again, thanks everyone.
Well, Brian and Brett, I appreciate the questions. I appreciate being called on for a point of view. The thing I'll just close with is, at the earliest stages of the COVID pandemic, peers began to share information on best practices. It really started around the whole business continuity, disaster recovery, to protect the safety of our employees like I've never seen before. The collaboration among banks has just been outstanding. So I appreciate you calling on me. And there are many folks that are just knocking it out of the park, in terms of, whether you're a workout officer or a BSA officer, or a chief of credit or risk. So people have really stepped up in the industry. So I'd knock on a few more doors and round out your perspectives from other bankers, but I'm glad you stopped by to say hello to me today. Happy to help out.
Thanks for that. I appreciate that. And thanks for all your thoughts this afternoon.
Okay.
And signing off from Brian, Brett, and Jim.
All right.
Take care, everyone.